Control of another Australian company has fallen into the hands of private equity. The Roberts family has agreed to sell its stake in Multiplex to Canadian property asset managers Brookfield. But with concerns in the US about rising interest rates and inflation, private equity activity may be waning, and the players may have to rethink what's best for shareholders in the longer term. And this may now include scrip as a guarantee to get investors over the line. Southern Cross Director and Head of Institutional Dealing, Charlie Aitken, shared his views with Sky Business reporter Desley Coleman.
Well, private equity has to realise that you can't just turn up with cash. Australian retail shareholders don't just want cash. And you saw that in the Qantas takeover. You've seen the Orica board reject a takeover that was most likely cash. And I think private equity is right in reassessing the vehicles and structures it offers in takeovers.
Okay, well, specifically this kind of an offer, is that attractive for a retail investor?
Well, you've got to think of it this way. In my view, it's too convoluted. There's 275,000 Coles Myer individual shareholders. They understand shares, they understand cash. Do they know what a convertible note is? More than likely not, and that's not being rude to Coles Myer shareholders. But going with convoluted structures, their investment bank ideas, in my way of thinking, it's just too difficult.
Well, just how attractive is this kind of alternative offer going to be for retail investors?
Well, firstly, the 275,000 Coles shareholders have to get their head around what it is. What is a convertible note? Is it listed? Is it unlisted? Does it just provide me yield and then some sort of conversion factor along the way somewhere? Whereas you've got the other offer, which will be Wesfarmers' offer, which will be Wesfarmers shares and cash.
Charlie, what's your view on the Coles sale process and how it's travelling?
The share market tells you a lot of things. Coles Myer shares have come back exactly to the Wesfarmers offer price. Wesfarmers shares have gone up about 8 or 9%, reflecting the fact that the market now thinks Wesfarmers are going to get Coles. I believe they're right. I believe that the information that the market is now working with, that Wesfarmers might be able to offer up to 50% scrip in the offer, is making Wesfarmers an absolute front runner in the deal and very hard to beat.
What is the best result for Coles investors and Coles Group, the company?
I think the best outcome is with Wesfarmers. I think Wesfarmers are proven growers of retail businesses. They own Bunnings. Bunnings is a wonderful success. It's had EBIT margin growth for the last 10 years. They grow businesses. They have a great history of growing businesses, and I think that Coles Myer is a turnaroundable business. And I think it also, if you accept the Wesfarmers offer, if Coles shareholders accept the Wesfarmers offer, you can roll into the upside of that. You can get upside and leverage to Coles being turned around. With just about all other offers that are known, they're either cash or they don't offer you that same leverage to the turnaround situation.
Okay, well, let's talk about private equity. Is that hunger now starting to wane?
Well, there's a bit of a lull in the private equity action at the moment. It's like private equity is taking a bit of a step back and working out, my tactics aren't quite working here. I like to say they're turning up with cash to a script fight. They've got to understand the unique dynamics of the Australian equity market, the Australian taxation system and the Australian superannuation market. People don't want cash. You've got to somehow compensate them for the dividend yield they've lost and somehow allow them to have some sort of upside to the ongoing leverage in the company that's been taken over. You've noticed that just about nothing other than small capitalisation stocks have been taken over by private equity successfully. So they have to reassess their tactics.
Well, is the market now getting a little bit bored with the previous sexiness of private equity?
Yeah, I think company boards are also considering, is this the answer? Is selling the company in a one-off hit to private equity the answer, or should I fire my managing director? I believe too few managing directors are being fired in Australia. I mean, if your company's underperforming, the first thing you should look at is management, not run off to private equity.
This week we saw another Aussie company falling into the hands of private equity, construction giant Multiplex. Are there any other companies that you might suggest are looking attractive for private equity?
It's pretty controversial, but I would say, and it probably will never happen, but the one I look at that has all the hallmarks of could be taken out by private equity, even though it'd be a complete political football and would never happen, is actually Telstra. Telstra has businesses that could be spun off, huge free cash flow, massive market positions. It has all the hallmarks of what private equity would seek, but I don't believe it would ever happen. I believe agitators could get involved in the Telstra share price, but we'll see.
Retail is obviously an attractive sector for private equity, but what other areas in the market do you think private equity might now be looking at?
They seem not to be able to get their head around resources. We've seen small cap sort of private equity plays in resources, but I just don't think private equity can get its head around big cap resources, despite the market wanting to believe that. The takeovers in resources are going to be resource company on resource company. That's what's going to happen. Private equity, it's just all a bit too hard in resources, and I don't think they get board recommendations either, by the way. Other industries, they're big in industrials, they may turn up in financials, but I look at things like beverages. Obviously they're huge in retail. Perhaps the next move from retail is to beverages. And I look at a company like Foster's, just sitting there, underperforming the market. Great brands, great cash flow, underperforming wine division. But if you split the company up and you split up CUB and geared up the earnings from CUB, the great beer business, it's a classic private equity target.
There is one person already, Brian Gilbertson, looking at the resource sector with private equity. He's suggesting consolidation in the Kambalda Dome that might rival the likes of BHP in the area. What do you say to that?
There's no doubt that there's going to be the odd bit of private equity in resources, but as Gilbertson's leading it, it's all in mid-cap and small-cap stuff, trying to consolidate the mid-cap space and build a mining house, a larger cap mining house to... I'll try that again. There's no doubt that Gilbertson is trying to use CSM to consolidate the mid-cap mining space. That may well work, but my point is I do not see private equity ever being involved in a BHP or Rio or anything of that scale.
Well, what kind of limitations would private equity be facing in that sector?
The first thing you've got to get past is the board actually ever recommending it. I do never see the board of BHP recommending a private equity takeover. It just will never happen. Look, you could gear up BHP, you could sell off assets, whatever, but that's why Marius has been appointed. Marius will do that for you. That's why the share price is rallying in BHP, because the Marius factor is why not do it yourselves? BHP will be a much more aggressive company under Marius Kloppers, and that's why the share price is rallying.